All right, so chapter 5 is on cost, volume, profit relationships. So tonight, we're going to go through an example. As we go through, you'll be able to see different scenarios, and we're going to use that same example throughout the whole thing. But if you have any questions during those examples, just go ahead and stop me and ask questions. And it's, we're changing a little bit on how we're doing our calculations tonight from what we did the first 4 weeks. It's a little bit different, but I don't think that it's hard. I think it's just different. And we might bounce back and forth like from the screens, but we are going to be talking about the same example pretty much for the whole presentation. All right. So we're going to have some assumptions that we make for cost, volume, profit. So we're going to have a selling price that's constant, which means whatever that selling price is set at, that's what it's going to be for each unit. The costs are going to be linear and can be accurately divided into the variable and fixed components. And you'll see what that looks like when we look at the contribution income statement format. We'll go over that. And the variable costs are going to be constant per unit. So those variable expenses are going to be the same for each unit. They're not going to change. And then if it's a multi-product company, the mix of products sold remains constant. Okay, so this is the contribution income statement. There were 2 different income statements that we had talked about earlier in the semester. And this is primarily used internally because they want to see what are the sales, what are those variable expenses, what is my contribution margin? Mainly that means what is going in to cover those fixed expenses, and do I have anything left over, or am I losing money? So they may want to look at the income statement this way so they can tell what is that contribution margin. You can look at it on a unit basis or however many units you're selling to see what's my break-even point. Do I need to make some changes in my fixed expenses to make more money? Can I sell some additional units at a lower price and still have some income on top of what I would normally get? And so this format helps them be able to see that very easily, and they can make decisions easily. So this mainly is used for internal purposes, and it would be converted to a regular income statement format if they were going to issue the financial statements externally. And the contribution margin is something that I want you to know what that is. Just remember that it's the sale of that unit, whatever that sale price was, less the variable expenses. And the variable expenses is going to be given to you so that you know how to calculate that. So the contribution margin is the amount remaining from the sales after the variable expenses have been deducted. So it's just sales minus variable expense, that's contribution margin. All right, so the contribution margin, obviously we want to make sure that we're covering fixed expenses. Hopefully we have a little more. And so if we have anything over the fixed expenses, that becomes our net operating income. And we're going to be looking at how to find what my break-even point is in order to calculate out how much do I need to sell in order to cover that fixed expense. All right, so right now we're going to break it out on a per unit basis. So the example that they're giving us is that we're selling 500 bicycles. The bicycles have a contribution margin of 200. So if you want to know how much is it per unit, we look at our total sales, which is 250,000, and divide it by the number of units that are sold. And they're telling us we sold 500 units. So it's just 250,000 divided by 500. That gives us the 500 per unit that's here. And then we have variable. and we can do the same thing. We can take that 150,000 and divide it by that 500 to come up with 300. We deduct it and get 200, which is our contribution margin per unit. So we know each time we sell a unit, we're going to make $200. All right, then it says each month they must generate at least 80,000 because that's the fixed expense. And in order to break even, they have to at least sell enough units to cover that 80,000 in fixed expense, because that's not going to change. That's what it stays each month. And so if we're not selling enough and we have those fixed expense and you start losing money, well, then you may need to make some adjustments. Also, you can look at this and say, okay, well, my fixed expenses are covered. And now if I wanted to make decisions on producing additional units and sell them for a little less, maybe I have a special deal, and we'll look at an example like that. You know that, okay, my expenses are already covered and I'm above it. I have some income, and now I can make a decision to sell maybe a little less. All right, so the 400 units is our break-even point. And the way that you can come up with that is look to see what your fixed expenses are and divide it by the contribution margin, which is 200. So I'm just taking that 80,000 divided by 200, and that should give me my 400. So I'm just going to check it real quick. Yeah. So this is my fixed. This is my contribution margin. So all I did was say, okay, if I divide that into that 80,000, how many units do I need to sell in order to break even? And so it's 400 bicycles. So that's my break even point. So this example is showing you that if I sold 401 units or 401 bicycles, that means that every time I sell it, I have $200. Well, if I sell one over that break point, then my net operating income should be 200. And it gives you the breakout showing you how much it is when you sell 401 bicycles, covering the 80,000 in fixed, and then you get that net operating income of 200. Which you should know just, from knowing that that's what it is per unit. If you won over, that's how you can check it. Okay, so we don't need to prepare an income statement to estimate the profit for a particular sales volume. So we can just say, here's the number that's sold above the break-even point and multiply it by the 200, which is that contribution margin, so that I know, okay, what is that operating income going to look like? In this example, I know that 400 is my break even, and they're saying we're going to sell 430 bikes. So they're looking at what is above that break even point. Well, it's 30. So I'm going to take the 30 and multiply it by my contribution margin so that I know what is my operating income going to look like. And here it is right here, 6,000. Okay, the contribution margin format for the income statement can be expressed in this following equation. So we have profit equals sales minus variable expense minus fixed expense. So they're just writing it out right here, which is basically what this, format is. They're just showing you how it is. So you can write that down and maybe keep that handy when you're doing your homework, and it'll help. There's a couple of formulas in here that you might want to keep handy when you're doing your homework. So we have the sales, which would be, oops, sorry. Let me see if I can go back one. I went hit too fast. Here we go. So there's our formula. All right. So in this example, we have 401. So we have, I don't know why it's doing that. Sorry, guys. There we go. 401 units at 500. So that's how we came up with the 200,500. I'm not sure why it keeps doing that. It's got the 401 times 300 less the fixed expense. And that gives you the 200. It's basically the same thing we just looked at on the spreadsheet, but it's just breaking it out. I'm just going to let it go. Okay. So when we only have one product, we can look at the equation a little bit different. And this could be handy when you work in some of the homework problems. We look at the profit equals sales minus variable expense minus the fixed expense. What are the sales? How do we calculate that out? Well, maybe we have a sale price per unit, but we don't know what the total in sales is. It's going to give you the quantity. So you'll be able to take the sales and calculate that out. We'll say, here's my quantity that I sold times the price of each one of each unit. So if I multiply those together, I get my total in sales. For my variable expense, I'm going to do the same thing. I'm going to look to see what is the quantity that I sold. And instead of looking at the sale price, I'm going to look at what is that variable expense cost and multiply it to come up with my variable expense. So they're showing you in the formula here, it could be your profit equals the price per unit times quantity minus the variable cost per unit times the quantity minus the fixed expense. So they're going to give you these numbers and you'll just be able to calculate it out. So they may give you a total sale, or they may say this is my sale per unit. Okay, so we show the 200 profit when we sell 401 bikes. So the formula would be 200 equals 500, which is my sale price times the quantity of 401 units, less the variable cost, right? So that's going to be my $300 per unit times 401 units, less the fixed expense of 80,000. So we have the unit contribution margin, which just equals selling price per unit less the variable expense per unit. So it's just P minus V. And then we multiply it by the quantity. So they're just saying you don't have to do the price times the quantity and then the variable times the quantity. They're just saying you can take the price less the variable expense, which gives you your unit contribution margin. So if we know the unit contribution margin in this example is 200 and we're selling 401, we can just say 200 times 401 and then less the fixed expenses. Okay, so we got the 500 minus 300, which is our 200, which is our contribution margin, times our quantity, less the 80,000. So we have 80,200 less the 80, and that's our profit of 200. So they're just showing you different ways to come up with the answer. All right, we are not going to do these graphs. So I am going to skip past these slides. Okay, so we're going to look at contribution margin ratio. All right, so the contribution margin as a percent of sales is referred to as the contribution margin ratio. This is the formula, so you might want to write that down because your questions can ask you for your contribution margin ratio. All it is the contribution margin divided by the sales. So in our example, we know that our contribution margin was 200, and then we would divide that by the sales. If we were doing per unit, it would be 500. So it's either going to be that you have the contribution margin in total. So okay, it's 500 units times the 200 gives me my contribution margin, and my sales are the 500 times the 500 units. And so either way, if it's per unit or in total, you're going to get the same percentage. All right, so in ours, we're looking at the contribution margin of 80,000. That's our break-even point, and then 200 was our sales, and so it's 40%. So we know by knowing that we have 40% that we're going to make 40 cents on each dollar increase in sales. The contribution margin ratio can be calculated per unit. So here's the contribution margin per unit over the selling price per unit. So in our example, we had 200 over the 500 selling price, and that's 40%. So whether you have the total or you have the unit, it's going to give you the same percentage. So the variable expense as a percentage of sales is referred to as the variable expense ratio. And that formula is just the variable expense over the sales. So our total was 120,000 in variable expense over our sales of 200. So that gives us a variable expense ratio of 60%. So now we have 100%. We have 60% for that variable expense ratio, and we have 40% in our contribution margin ratio, and that total is 100%. All right, so this is another way that we can look at it. So you may have an example that gives you a variable expense ratio. So you don't have to do all the calculations out to calculate your contribution margin ratio. You can say, oh, okay, well, my variable expense ratio is 60%. Well, I can just do 1 minus that to come up with 40% instead of doing the division of your contribution margin over your sales. This is right here in the middle, this little formula, that's just breaking out the contribution margin. Contribution margin, that is sales minus variable expense. So it's not a different formula, it's the same thing. It's just on this top one, they put contribution margin. This one, they broke it out. So contribution margin is sales minus variable expense. Or you could do this way for your contribution margin ratio calculation, just do 1 minus the variable expense ratio if you have that. Or you could do vice versa. If you have let me go back. If you have your contribution margin ratio of the 40%, you can do 1 minus 40% to come up with 60%, which is your variable expense ratio. You don't have to do the calculation out. Okay, so we want to increase sales from our break even of 400 to 500 bikes. So we have an additional 50,000 in sales. That's just 100, bikes times the 500, and that gives you the 50,000. So we're selling 100 more units, and it's 500 per unit. So that's how we come up with the difference. It's 200 if you take the 500 times 400, 250 if you take the 500 times $500 times the 500 units. Then we have the contribution margin. It shows that it's going to increase by $20,000. So if you do the math on the 40 units, you can see the 120,000 for variable expense. If you deduct that from the 200, it gives you 80,000. And then if you calculate your variable expense at 300 is what they gave us in our example. Oops, it didn't write, sorry. We have 300 in variable. Okay, it's not letting me write now. Do pin. So if we have 300 times 500 units, and we're going to get the 150,000. And then we deduct that from the 250 in sales. So now we have 100,000 for our contribution margin. So it's showing you the math of the difference being 20,000. But you can also calculate that out without doing all of this. You can say, okay, 40% is my contribution margin ratio, and I'm going to multiply by my additional sales, which is 50,000, and that is going to be 20,000 that I'm going to increase my net operating income. So now I have net operating income of 20,000 instead of my break even and having zero profit. Okay, so you can work it out and see the difference in the units if that helps you understand it, or you can just, if you know what your contribution margin ratio is, they're just saying you can take that and multiply it by the increase in sales, which is 50,000, to come up with what your additional income is going to be. All right, so let's look at an example. So we have Coffee Klatch is an espresso stand in a downtown office building. The average selling price of the cup of coffee is $1.49, and the average variable expense per cup is 36 cents. The average fixed expense per month is $1,300, and an average of 2,100 cups are sold each month. Well, this must be an example from a long time ago, because coffee that I buy at like Starbucks is definitely not $1.49. So we have, what is the contribution margin ratio for Coffee Clutch? So we have to remember what our formula is. We have, it's not going to let me write. I'll just leave this up because it didn't let me do it. So it's showing you the formula, contribution margin ratio. We have our unit contribution margin divided by the unit selling price. So what is our unit contribution margin? Remember, that is sales minus variable expense. So we have our sale price of $1.49 less the 36 cents. And then we divide it by the selling price, which is $1.49. So you have $1.13 over $1.49. That's going to give us a margin, contribution margin ratio of 0.758. Now we're going to follow this example, just like we're following the example in the problem that they gave us in the slides. This example, we're going to use this example several more times. So we'll remember that number. The contribution margin ratio is 0.758. All right, so we're going to look at the relationship between the profit and the contribution margin ratio, how it can be expressed in that formula, that equation below. So we have profit equals contribution margin ratio times the sales less fixed expenses. So we have 500 bikes in sales volume. And it says, what would management expect profit or net operating income to be? So we looked at it already on the contribution income statement. This is not laying it out that way. This is looking at, okay, I know what my contribution margin ratio is. So how am I going to figure that out based on that without having to put it in that format? So we look at the contribution margin ratio of 40%. We're going to multiply it by our sales and we get 100,000. And then we subtract out those fixed expenses to come up with a profit of 20,000, which is the same thing that we just calculated out. All right, so we're going to look at some examples where we change a few things. So we're going to change the fixed costs and the sales volume. All right, so it says, what is the profit impact if they increase the sales units from 500 to 540 by increasing the monthly advertising budget by 10,000? All right, so we're increasing the advertising budget by 10,000. That is part of your fixed expenses. Okay, so instead of having 80,000 in fixed expense, we're now going to have 90,000 in fixed expense. So we're going to have the 80,000, and we're going to add the 10 to it. So we're going to have now 90,000 for our fixed. All right. And so we know that our sales unit is going to go from 500 to 540. So we're increasing the sales. All right. So we know that this was given to us, right? The 250. So if we want to increase it, so now we've got the 540 times 500. That's going to give me 270,000. 300. So the 540 times 300 to get my variable expense, that's going to be 162 instead of 150. Now we got 108. Okay, this is my contribution margin. Now I have my fixed. So this was 80. Now it's going to be 90 because we're changing. We're going to increase that. So what happened? We made less 2,000. So maybe we decide we don't want to do that. We don't want to increase the advertising budget by 10,000 just to sell, 40 more, because then it's not going to cover the sale of those bicycles. We're going to actually have less in profit if we do that. So maybe that's not a good decision to do. Okay, so here's the example broken out for you so you can see. So it's just doing what we just did, taking the 10,000, adding it to 80 to get the 90. And they're showing you how your increase, your sales by 20,000, but the operating income is going to decrease by 2,000. So we can look at it this way. This is a little shortcut. So if we say we're going to increase by 40 units, multiply by that contribution margin, right? This is what we have after we take those variable expenses out. So for 40 units times 200 gives us 8,000. Our increase in advertising is 10,000. So we can see we're going to have a decrease in our income of 2,000. So that's another way that we can look at it without having to break everything out. All right, so let's look at a different example. So we have, what is the profit impact if they use a higher quality raw material, which will increase the variable cost per unit by $10. So remember, it was 300. Now it's going to be 310. And then we want to generate an increase in units from 500 to 580. So now we're increasing our sales in units by 80. So let's see what that looks like. All right, so here's our 580 units. We're multiplying it by 310 because remember it was 300. We're adding that additional $10. So now we have 179.8. So that becomes our new variable expense. The 580 units to get this 290, that's just multiplying the 580 times your selling price of 500. That didn't change. That stayed the same. So now our contribution margin is 110,200 less 80,000 and fixed. Now our net operating income goes up to 30,200. So we increased our sales by 40,000 and we increased our net operating income by 10,200. Okay, so this example, they were buying a raw material that was a better quality and it cost more. However, when we did that, maybe the quality of the bike is a little better, and so we had more in sales. We're anticipating that, you know, we're going to have 80 more units sold. So that might be a good decision. So even though it's a little bit higher in costs, you would think that maybe it would go down. Possibly it won't because you're going to sell more units. All right, so let's look at this example. So we're going to cut the selling price $20 per unit. So remember, it was 500. Hang on, it didn't let me write it again. I don't know why. It was letting me just write without flipping the page, and now I have to click on this button. Okay, so we have 500 less the 20. So now we're going to have a sale price of 480. All right, we're going to increase the advertising budget by 15,000. So our advertising budget is going to get added to that fix of 80,000. So now we have 95,000. And then we're increasing our sales from 500 to 650. So that's an increase of 150 units. All right, so let's see what that looks like. All right. So here's the calculation for our 650 units times 480. So we're selling a little lower. It's 312,000. We still have 300 as our variable expense. Nothing changed there. So we would just take 300 times the 650 units to get the 195. So our new contribution margin is 117,000. Our new fixed expenses, because we added that 15,000 in for advertising, we're going to do a 95,000 fixed expense. We're going to deduct that. So now my net operating income increases by 2,000. So it's 22,000. So we increase our sales by 62,000. We increase our fixed costs by 15,000. And then our net income, it only increased by 2,000. So maybe we wouldn't want to make all of those changes. Maybe we want to tweak that. So, you know, do you see this format helps you to see your different scenarios? And if you make changes, what would the outcome be? it helps managers make a decision, yes or no, I don't want to do this, or I do want to do that. Okay, so we have $15 in commission that we're going to pay per bike when we sell, instead of paying the salesperson that flat salary of $6,000. So now what happens is, this is a change. So we initially had that $6,000 as part of our fixed expense. So now our fixed expenses are going to go down. They were 80. So we're going to go down by 6. And now my new number is going to be 74. Okay. And then what happens with this 15? So now it's going to be, so, you know, it's going to be a cost per bike. So our cost of variable expense was 300. We're going to add that 15 to it. So now we're going to have that variable expense at 315 instead of 300. And we're going to increase our unit sales from 500 to 575. So we've increased our units by 75. All right, so let's see what that looks like. All right, so 575 times the 500 gives you the 287.5. Then they do the calculation for you that the variable cost was increased. So it went to 315 times the 575. So we have a new variable expense of 181,125. Contribution margin of 106,375. Less the expenses, the fixed expenses, it's going to be now 74,000 because we reduced it. We're not paying that commission there. And so now the operating income is 32,375. So our sales increased 37.5. Our fixed decreased by the 6,000 in fixed. We increased that per unit of variable expense by $15, and that caused our net operating income to increase by 12,375. All right. Now, this is what I was saying, that, you know, when you know what your contribution margin is, are you covering your fixed asset, you know that you have some profit, you may want to make a deal and sell additional units at a cheaper rate. So it's saying that they have an opportunity to sell 150 bikes to a wholesaler without distributing sales to other customers or fixed expenses. What price it would quote to the wholesaler if it wanted to increase the monthly profits by 3,000. So we already have everything else covered. And so now we're just looking at, okay, I want to make an additional 3,000 if I want to, you know, sell these 150 bikes. So what do I need to do? So we have 3,000 in additional profit divided by that 150 bikes. So we're looking at $20 per bike. The variable cost per bike is 300. So we would need to sell it to cover that variable expense, plus an additional $20 to get to the 3,000 that we want in additional income. Okay, so everything else is covered. The fixed asset, fixed expenses are covered, and now we want to make sure we make an additional 3,000. So when you do that, you can calculate it this way. I want to cover what I need to cover for the expense, the variable expense per unit, which is 300, plus I need that additional $20. So I can sell it at $320. That's going to give me 48,000 in sale price. I'm going to have a total cost of 45,000. And so I increased my operating income by 3,000. All right, so we talked a little bit about finding that break even earlier when we first started. And so we're gonna go back to that and look at it again. So remember, we calculated on this example that we had to have 400 units in order to break even. And we did that by knowing what our contribution margin was for per unit and what our fixed expenses were. Okay, so we can write it out. We have profit equals unit contribution margin times quantity minus the fixed expense. So when we put the numbers in for the profit, because it's a break even, you would put 0. And that way, you know that, okay, I'm not making anything, I'm just covering the cost. What is it going to cost for the quantity, and what is it going to cost for that fixed expense? And then I can calculate out what my break even point is going to be. So we have 200 times the quantity equals 0 plus 80, because remember our fixed expenses are 80. So all they're doing is plugging in the information into the formula. So if we would have put the number here, minus 80,000, all they're doing is solving this algebraically. They're just adding 80,000 to the other side of the equal sign. So they kind of flipped it around instead of bringing the 80 on the other side by the 0, but that's all they did. So you have 200 times the quantity equals 0 plus 80,000. So we know whatever we do here with this quantity, it's got to cover that 80,000. So we're going to divide by 200 to get the quantity by itself. So we have the 80,000 divided by 200, which is 400 units. And we had done that a little bit earlier, like one of the first slides. All right, so if we want to know the unit sales to break even, then we would just put fixed expenses over unit contribution margin. So this is the same thing we did on that first slide that we did to calculate the units, was just do it this way. We did 80,000 in fixed expenses divided by $200 for the contribution margin, and that gives us 400 units. So that's our unit sale to break even. We have to sell that many. All right, so they want to compute the sales dollars required to break even. Then let's use the equation method and the formula methods to solve the problem. So we're going to look at 2 different ways. So here's the equation method. So we have that contribution margin ratio of 40%. We calculated that out earlier, times the sales minus the fixed expenses. Well, we know the fixed expenses is 80,000. So we're going to take the 80,000 divided by 40% to come up with 200,000 in sales. All right, so now the formula method. So it's just the fixed expenses over that contribution margin ratio, 80,000 over 40%. So the dollar sales is 200,000. All right, so that we're back to our example. So remember, our selling price is $1.49. The variable expense is 36 cents. The average fixed expense per month is 1,300. An average of 2,100 cups are sold. What is the break even in sales dollars? So what did we need? We needed to know what our fixed expense was, and we needed to know what our contribution margin ratio was. Remember, in number 1, we calculated that out. So we know, hang on, let me get the pen. We know that contribution margin ratio that we calculated from number 1 was 0.758. Okay, so we're going to do fixed expense over that contribution margin ratio. And the fixed expense is given to us 1,300 divided by 0.758, which is going to equal 1715, so B. Okay, and there's the slide that gives you how to solve it. Okay, now they want to know an average of 2,100 cups sold. What is the break-even sales in units? So the sales in units is going to be that fixed again over that contribution margin per unit. So we know that this is 1,300. What was our contribution margin per unit? How did we calculate that? Remember, we took the sale price minus the variable expense. That gives us our contribution margin, which is the 113. and then 1,300 divided by the 113, it's going to equal the 1,150 cups. Okay. So that's our units. That's how many cups we have to sell to break even. Okay, and there it is, worked out for you. All right, so that was the break even. So we weren't looking at a profit, right? So now let's look at a target profit. So we can solve it either way, whichever way works best for you, the equation method or the formula method. All right, so we want to know our profit. So instead of having 0, we're probably going to have some number there that we have in mind. It's going to equal the unit contribution margin times the quantity less fixed expenses. So this formula is the same. And we need to figure out how many units do we need to sell to get that target profit that we want to make. So let's look at an example of that. So we have management wants to know how many bikes must be sold to earn the target profit of 100,000. So instead of putting a 0, now I know I gotta cover the, the fixed expenses, but I also want to make 100,000 on top of that. So I have 200, which is my contribution margin, times how many units is going to do that. So my total that I want to cover is the 180,000. I have 100,000 in profit that I want to make, plus I need to cover that 80,000 in fixed expenses. So it's 180,000 divided by 200. So it's 900 units. So now I know how many units do I have to go out and sell in order for me to reach that profit, that target profit that I set for myself. So we're doing the same formula, you just plug in a number for the profit instead of 0. Okay, and then a formula method uses the following equation. So it's basically the same thing, just setting it up a little bit different. We have that target profit plus the fixed expenses divided by the contribution margin unit. So either one will work. Because remember, we had that 100,000 in profit that we want to make, and we have the 80,000 in fixed to cover. So it's 180 divided by 200. Gives us our 900 units. Okay, so we can also compute the target profit in terms of sales dollars using either the equation or formula method. So whichever way is easier. So we know the contribution margin ratio is 40%. So we can put in our profit of 100 equals the 40% times sales minus 80,000. So again, I have that 100 and the 80,000 adding together, and I'm going to divide it by 40%. So now I know I need 450,000 in sales to meet that target profit. Okay, so we're using the contribution margin for that ratio. All right, and this is the other way you can do it. You can just take the target profit plus the fixed, add them together, divide by 40% to come up with your sales of 450,000. Y'all have any questions so far? Is it making sense?
Yeah, there's just a lot of formulas.
Yeah, and when you're going through it and you're seeing them for the first time, it seems like a lot. But remember, the formula doesn't change if you're looking as a total or as a unit, and they're kind of doing both. So it seems like you have, 2, but it's really just 1. And then the way that we're doing it is we're doing it twice, looking at 2 different methods. Pick a method that makes sense to you and stick with that. Whichever one you feel you understand the best. And you'll know that just from going through some of the homework and doing the examples, which one makes more sense to you. And then use that formula. So that way, it's not, it doesn't look like it's a whole lot, and you're not trying to remember 2 ways to do it each time. So the formula method might be better than the equation. It seems like it could be a little easier to see the numbers, for me anyway. All right, so we want to use the formula method to determine how many cups of coffee would have to be sold to attain target profits of 2,500 per month. All right, so we've calculated our break even. I think that was number 3. So now we're looking at a target of 2,500. If we want to make that now, let's calculate that out. All right, so we want our target plus the fixed over our unit contribution margin. Target is 2,500. Fixed they give us is 1,300. And our unit contribution margin that we calculated out, remember that's just the sale minus the variable expense. Sale minus variable expense equals contribution margin. So that's going to be 113. All right, so when you do the math on that, you're going to come up with 3,363. So it would be A. Okay, and there it lays it all out for you. So if you have to go back to the slides to see how to come up with the number when you work on your homework, they give you these slides that break it down for you, which is really nice. All right, now it says determine the sales dollars that it must be generated to attain a target profit of 2,500. So now we want the sales dollars. So we had the units, now we want to know the sales dollars. So we're looking at, let me zoom back on. The highlighter of the pen. Okay, target plus the fixed over the contribution margin ratio. Okay, so we know 2,500 plus 1,300. We calculated out on number 1 the contribution margin ratio of 0.758. So when you do the math on that, it comes out to 5,013. So B. Okay, so there's your target profit plus your fixed expenses over your contribution margin ratio. And it breaks down right here how you do that. So the contribution margin ratio is the contribution margin, which is that $1.13, divided by the sales price. Okay. And then you can calculate it all out right there if you didn't know what it was. All right, now we're going to look at margin of safety. So the margin of safety is the excess of budgeted or actual sales dollars over the break-even volume of sales dollars. Okay, so it's over the break-even. It's the amount of which the sales can drop before losses are incurred. The higher the margin of safety, the lower the risk of not breaking even and incurring a loss. Okay, the lower the risk of not breaking even. All right, so we have our margin of safety equals total sales less break-even sales. Okay, so we're going to look at what is our total sales and what are our break-even sales, and that difference is our margin of safety. All right, so we're going back to our example between the break-even of 400 units, the bicycles that we calculated out. Remember, we took the 80,000 and divided by that 200, which was our contribution margin, and that gave us 400 units. So that's how we knew 400 units was our break-even point. That's going to cover the 80,000. Then they gave us a scenario that we sold 500 units and did the calculations and showed, okay, well, it's covering not only the fixed expenses, but we're also going to have a net operating income of 20,000. All right. So the margin of safety is 50,000. That is the difference. So let me go back. The difference between our sale price and the break-even sales. Okay. So when we sell 500, we now have a total sales of 250. And we deduct our break-even sales, which is 200. So that margin of safety is 50,000. Okay, so the margin of safety can also be expressed as a percent of the sales. All right, so if we know that the increase in sales is 50,000, so we take that 50,000 and we divide it by the sale amount of 250 for 500 units, we can come up with 20%. Okay, so all we did was take the difference in the sales, that's 50,000, and divide it by the new sales if you have 500 sales, 500 units that you sold. So that would be 250,000. When you do the math, it's 20%. And then we have units. So it says it can be expressed in terms of units. So the margin of safety at 50,000, that's the difference in the sales, remember? And each bike sells for 500. So the margin of safety would be 100 bikes. So all we're looking at is the difference between that break-even point and the new sale amount with the new units, which was 500. So we have the difference of 50,000. And then we divide it by the sale per unit. Okay, so that gives us 100 bikes. So our margin of safety is 50,000, just the total sales less the break-even sales. And the total margin of safety for units is 100. And all we did was take that difference in sales and divide it by the sale price per unit to come up with how many units is that. So it's 100 units. So remember, we went from 400 to 500. That's 100 units. Okay, so let's look at it for our example. So number 6, so we have an average of 2,100 cups are sold each month. Okay, so then it says, what is the margin of safety expressed in cups? So we want to know the units, the cups. Okay, so how many units are we selling on average? It's telling us 2,100. So we're going to take the 2,100 in units and deduct our let me see what example it was. Our break-even units, when we calculated that out, it's number, I think it's quick check number 3. All right, so we have sales of 2,100 cups. Our break-even was, when we calculated that out, we got 1,150 cups. So to calculate the cups, the break-even, we used our fixed cost, which was 1,300, and we divided it by the contribution margin, which was 113. That's just the sale price less the variable expense. Okay, and that gave us the 1,150 cups. So that's number 3. That's where I'm getting that number from. So we take the difference between the two, and we get 950 cups. So B. Okay, and they're showing you that math, but they're not showing you where the 1150 came from. So just remember that that's from number 3. Okay. See, I think that might have been the last one for our example. We'll come back to it in a little bit different. We're going to talk about something else. Okay. So cost structure refers to the relative portion of the fixed and variable costs in the organization. And managers often have some latitude in determining the structure. So we're going to look at that real quickly. So we kind of went through some different scenarios on things that we could do, right, that change our net operating income. So there's some advantages and disadvantages with the high fixed costs or low variable costs, or low fixed costs and high variable costs. So we looked at a bunch of different scenarios, and you could see each time you made a change with how many you sold and how much you sold it for. Or did the variable cost change per unit? If we change the fixed costs, how does that affect our net operating income? So there's some advantages when we do that. So if we have high fixed costs, it's saying that the income will be higher in good years. and compared to companies with lower proportion of fixed costs. Okay, so if we have high fixed costs and we have income that will be higher in the good years, because the fixed cost isn't going to increase. Remember, it stays the same. So if we have higher sales, then we have more units that are sold, and then we're not increasing any fixed costs. So then that could be good. But then there's a disadvantage if we have that high fixed cost structure, because if we sell less in that year, then we have a bad year in sales. Well, now it looks like we have a lower income in comparison to a company maybe that has a lower proportion of fixed costs, because those fixed costs don't change. So just like you get the advantage when you have more in sales, you're going to have the disadvantage when you have less in sales, because you still have to cover those costs. So if your sales go down and you're covering that high cost, well, then obviously your profits go down, or you maybe even lose money. So there's an advantage or a disadvantage to using that. And so companies with the low fixed cost structure enjoy greater stability and income across good and bad years. And that's because when you move your some of those costs into the variable cost, then that variable cost is fluctuating with the number of units that you're selling. So, you know, if you're selling more units or less units, that number is being affected because it's per unit. So if you have the adjustments going into your variable expense and you keep your fixed costs low, well, then that helps have a little better stability, and the costs are kind of working evenly with how your sales are for that year, whether they're high or low. So that's all this is saying, is that there's an advantage and disadvantage with having a lot of fixed costs, and it could be better if you had less fixed costs and had maybe a little bit higher variable cost, because then those swings won't be as bad. So that's all the slide's saying. All right, so we're going to look at degree of operating leverage. So this is another formula that you want to jot down. So we have degree of operating leverage, and all it is your contribution margin over your net operating income. So now the trick here is maybe they don't give you your net operating income. You may have to calculate that out. So you have to remember, how do we calculate it in order to put that into the formula to come up with your degree of operating leverage. All right, so here's our income statement that we looked at. So our sales for 500 bikes is 250,000 less our variable expense of 150. So remember, it's 500 and 300. Contribution margin is 100,000, which is just 200 per unit times 500. Then we cover those fixed expenses of 80, and we had an income of 20,000. So we had this information given to us, so it's real easy. We just plug it in. Sorry, my lights just went off. Hang on. They do that in the office if I don't move for a little bit. All right, so we know that our contribution margin is 100,000 because it's given to us, and we're going to divide that by the net income of 20,000, and we have a degree of operating leverage of 5. So how to calculate it is pretty simple if you have the numbers. If not, then you got to figure that out. You got to figure out what that net operating income is in order to put it in. Okay, so this is explaining what does that mean. So we have an operating leverage of 5, but what does that mean? So if you increase your sales by 10%, the net operating income would increase by 50%. So the way that you do that is say, okay, I want my percent of sales to increase by 10%. I'm going to multiply it by my degree of operating leverage of 5. And now I get 50%. So I will increase my profits by 50%. And they're going to show you the calculations to show you that that's true. All right. So we're going to increase our sales by 10%. So we're just taking that 500 units, and then we multiply it by 10%, and we get the 550. So the easy way to do that is just do 500 times 1.10. So if they said 20%, it would be 1.20. And that way you don't have to just say, what's 500 times 10%, get the number and then add it back in. Take the 50 and add it to the 500. You can just do one calculation. So 500 times 1.10 equals 550. So I'm increasing my units to 550. And if you did the same thing with your sales, the 250,000, it would work to be the same way. So if I do my 250,000 times 1.10, I get 275,000. Okay, so you don't have to actually calculate all that out. You can just multiply by 1.10. So I'm increasing sales by 10%. So now I need to verify, I got to work all the numbers to verify that my net operating income increases by 50%. So everything else stays the same. So I have my 550 units times 300. I get 110,000 for my contribution margin. 80,000 is my fixed. And so now I have a net operating income of 30,000. So if I take 20,000 and multiply it by 1.5, because I want to increase it 50%, that gives me 30,000. So they're just showing you here, when you work out the numbers, here's your increase. So they're showing you, here's my increase of 10%. And yes, it did increase my profit by 50%. Okay, so if I know my profit's 20,000, I know my degree of operating leverage is 5, and I'm increasing sales by 10, I can do the calculations without having to do the entire income statement. I can just take the 20,000 net operating income and multiply it by the 50% and get my new operating income. All right, so we're going to look at our example that we did with our cups. We're going to have to work this out. So it says, what is the operating leverage? So the formula was the contribution margin over the net operating income. Okay, so we never calculated out the net operating income, so we need to do that. So let's look at our sales. We had $1.49, a variable expense of 0.36. And what was our quantity? Our quantity is 2,100. It's given to us. So let me move this over here. So if we have 2,100 units at 149, our number is 3129. We have 2,100 units at 36 cents. That's me 756. So now what is my contribution margin? It's 2,373. Less my fixed, 1,300. That is going to give me my net operating income, which is 1,073. So now I can plug into my formula because I know my contribution margin and I know my net operating income. So we have 2,373 contribution margin divided by net operating income, 1,073, and that gives me 2.21. So this is my degree of operating leverage, 2.21. And they do have a slide that gives you all of this a little bit neater. So it works it out. So it's showing you, okay, I have 2,100. It just gives you the math. You just have to go back to the example and plug in the numbers to get your, what they're multiplying by to get these numbers, okay? And then it gives you your formula again here to plug in, and then you get your number of 221. Okay, so now that I know my degree of operating leverage, I want to look at my sales increase by 20%. How much should net operating income increase? Well, remember, we look at 20% is what we want our sales to increase, and we got to multiply that by our degree of operating leverage. So our number that we just came up with was 2.21. So when we do the math, at 44.2%. Okay, so they're telling us we're increasing the sales by 20%. What is my operating income increase going to be? It's going to be 44.2%. Okay, and there it is for you. And then they'll break it out and show you the numbers to show how that is. So we had 2,100 units we're increasing by 20%. So remember, you can do times 1.20, and that gives you the 2520. So if we take 2100 cups times 1.20, that's going to give me 2520. So this is my percent increase of 20%. So that's how I do the calculation to come up with the increase. Okay. So then I just taken your 2520, multiplying it by your 149 to come up with your 37.55. Multiply the new quantity times 36 cents, 907. So now I have a contribution margin of 28.48. Less my fixed expenses would stay the same. So now my net operating income went from 1073 to 1548. So if I check that, it should be, the difference should be 44.2% as my change in net operating income. So I can check that real quick to see. And that is correct. So all I did was take the 1073 times, remember, put the 1 in front, 1.442. And I came up with 1547.26. So rounding, so it's 1548. So if I check it, it matches. This is working out all of the numbers, but if you know what the net operating income was, which we calculated on that last example, number 7, the 1073. Once you figure out your degree of operating leverage and then you know your increase in sales, you can calculate out that percentage. Then you can just take that number, multiply it by the 1 point, whatever the percent is, and come up with your new number without having to work everything out. But that's a good way to check it if you wanted to do that. Okay, stay with me. We're almost done, okay? Do y'all have any questions on any of those examples we just did? Okay, so looks like we're okay. I can't find my chat box again, so. All right, there it is. I don't see anything on there. Okay, so companies generally compensate salespeople by paying them either a commission based on sales or a salary plus a sales commission. So commissions are based on sales dollars. They can lead to lower profits in the company. All right, so a lot of times companies will pay a commission either on one of two ways. One is on the sales. If you're getting paid on what you sell, normally the commission rate is low. So it might be like 2 or 3% of what you sell if it's, you know, high dollar sales. Or they'll say, we'll give you a percentage of the margin, the contribution margin. So whatever that sale is less the expense, that difference, we're going to give you a cut of that. So it might be 20% or 25%. Usually that number is higher. So if you're getting paid on sales, those dollars are higher. And so your percentage is lower. And then if you're getting paid on the profit, then your commission usually is higher. So I just wanted to let you know that. So 25% is very common. It was when I worked in the auto industry, when we paid the sales commissions for the sales reps that sold cars, they would get 25% commission on the profit that was made by the dealership on each car. And then in the AV industry, it was the same thing. It was 25% of the profit. We had some people that were just coming in and they would get paid on the sales. So so it just depends on the company and the structure and how they decide to do that. So they're saying that there's a disadvantage though if they pay you on the sales, and they're going to give you an example of why that possibly could be. It might not be in the best interest for the company to pay commissions on the sale price. So we have Pipeline Unlimited produces 2 types of surfboards. So they have the XR7 and the Turbo. The XR7 sells for 100 and generates a contribution margin of $25. And then the Turbo sells for 150 and earns a contribution margin of 18. So if you are a sales rep that's getting paid commission on a percentage of sales, you may be motivated to sell the product that has a higher sale price. However, it may not be in the best interest for the company because the margin is lower. And so they're just saying the sales rep might be motivated and sell the one that they make more compensation for themselves versus the one that has more margin for the company. So the sales force at Pipeline Unlimited is compensated based on those sales commissions. And so now if you're in sales, you'll push to sell the Turbo. Why? Because the Turbo has 150 sale price where the other one was only 100. Okay, so to eliminate the conflict, commission can be based on the contribution margin rather than on the selling price. So now the contribution margin on the other is 25, which is higher than 18. So they may be motivated to sell the product that has a higher margin, not just the higher sale. Okay, so anyway, just keep that in mind. I know some of y'all may go into a position, you know, that gets paid commissions. And so you might want to, you know, look at what they're saying they want to pay you on sales, maybe look at what average sales are per month for good sales reps. And then if it's on margin, then you may want to ask, okay, so what is your margin? What, you know, how much are you making on your products? And figure that out before you accept into an agreement. So, so if you go into sales, a lot of marketing people will, or business majors will go into some type of sales positions. So you might want to calculate that out before you accept. Okay. All right. So now we're going to look at a multi-product company and the break-even point. All right. So the sales mix is relative, is the relative portion in which the company's products are sold. So different products have different selling price, cost structures, and contribution margin. So even though you're selling two different things at the same place, it doesn't mean that the contribution margin is going to be the same in percentage. Okay, so different products may have different percentage points. So you might sell, like we just looked at, surfboards that have two different contribution margins, right? One's higher than the other. Okay, so that's what all it's saying. So when a company sells more than one product, the break-even analysis is a little bit more complex. You may want to add it together and look at it and see. So we're going to look at an example with the bikes again, but we're going to add carts to it to look at the sales mix and see what it looks like to come up with our contribution margin and our mix, how we're going to figure it out and how we're going to break everything out. Okay, so we have our bicycle. So this is the same, you know, we had the 500 units in sales. These are our percentages over here, our contribution margin percentage and our variable expense ratio. Then we have our carts. So now this is the new piece that came in. So it shows that the variable expense ratio is 45% and the contribution margin ratio is 55%. So it's a little different. And when you total them together, this average is 48.2. So the way that they calculated that out was they total your sales, your variable expense, get your contribution margin of 265. That's your number on top, contribution margin, divided by the sales, which is 550. And that gives us our average contribution margin ratio, 48.2%. Okay, and then they're showing our sales mix down here. So we have 250,000 coming from sales, 300 sales of bicycles, and then we have 300 in sales coming from carts. So it's a 45%, 55% split on how we get those sales numbers. Total sales will be in 550. All right, so we have our dollar sales to break even. So we calculated out what that contribution margin ratio was. We added everything together in order to calculate that out. Okay, so that was on the previous screen. So we have that now. And it's showing us on an example that our fixed expenses are 170,000. So we take the fixed expense of 170,000 divided by the contribution margin ratio of 48.2%. And we get 352,697 as our sales. So now if we want to break that out, remember it's 45%, 55%, how it's broken out in the sales mix. So we would just divide that up. So we'd take that 352,697. What's 45% of that? It's 158,714. And then we do the 193,983 for the 50. It would be 352,697 times 55% to come up with the carts. Okay, so that's our sales mix down here. So the numbers changed a little bit once you calculate out the dollar sales to break even. Okay, so where's the previous here? So this was our previous sales. It was showing us, we know here that we had fixed expenses of 80 and we made like 20. And so I guess the difference would be the cart's fixed expense, because now they're saying that the fixed expense is 170,000 and we only had 80 originally. So a little bit different. So now it's showing what that sales mix looks like when we're trying to have a dollar sales to break even. Okay, so we're just trying to cover that fixed expense of the 170,000. So we're basically doing the same thing. It's the same, calculation, same formula. The only difference is that we have to add the two together. And then once we get the two together here to get the contribution margin together, then we just divide it by the total sales of the two together, okay, to come up with that 48.2. So that's what we use for that contribution margin ratio, is the one that's the average on one of the two combined. Okay, so that is it for the lecture. So do y'all have any questions about that chapter?